All right, options traders, listen up. I want to tell you a bit about public.com. But first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees. And in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. To recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for option trading, and start earning up to 18 cents per contract traded, only at public.com. Paid for by Public Investing, options not suitable for all investors and carry significant risk. Full disclosures in podcast description, U.S. members only.
Welcome to The J-Row Show. On this podcast, your host, John Rotanti, interviews experts in and outside the world of investing. The J-Row Show dives deep into what it takes to achieve mastery and sustain top-level performance. As a quick reminder, this podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. All opinions expressed by John or any of his podcast guests are solely their own and do not constitute formal advice or recommendation. Now please enjoy this episode.
I'm John Rotanti, and this is The J-Row Show, a podcast that explores what it takes to achieve mastery, sustained performance, and longevity. The show hopes to uncover the processes, structures, frameworks, and mindsets that professionals put in place to maintain winning performance in their respective fields. Today, I am joined by Bill MIiller IV. Bill is the chairman, chief investment officer, and lead portfolio manager at MIiller Value Partners, and one of my favorite investors. Bill, welcome to the J-Row Show.
John, thanks for having me. It's so cool to be here.
Awesome. So let's just dive right in. Bill, tell us about MIiller Value Partners.
MIiller Value Partners is an active fund management startup company at this point in time. We manage just over $250 million of discretionary assets across 4 strategies. We have an undervalued income strategy. We have a capital appreciation strategy, which is in an ETF wrapper. We have another ETF product, which is a systematic leverage fund. And then we have a deep value strategy, which focuses, which has a concentrated portfolio with limited capacity to invest in a concentrated fashion in heavily undervalued entities. So those are our 4 strategies. We were founded by my dad approximately 25 years ago as a joint venture with Legg Mason. And through a variety of twists and turns over the years, we are now independently owned, 80% by me and 20% by my dad. And we are actively looking at using that the new firm entity and structure to incentivize team members, dish out equity, and change the overall operating structure of the firm. So we're actively evaluating proper incentivization techniques. We're evaluating all aspects of the firm, which I don't think it had a fresh look taken a look at them in many decades. So we're excited to be actively looking at new marketing strategies as well, which we've been really excited about. And we got a lot going on. So MIiller Value Partners is up and running. We are the biggest investors in every single strategy we manage. So I think that makes us really unique. Alignment is a major theme for us, not only personally, because we have so much of our own personal capital in all of our strategies. It's also important for us when we pick our investments. So when we look at every single stock, that alignment factor is critical. Are the people making decisions on our behalf aligned with us? Are they making money as a shareholder? Are they making money off of the shareholders? So alignment is a critical factor that I think is probably under focused on in the investment universe broadly speaking. And I think it's something that we're more heavily focused on than most. So that's a high level view of Miller Value Partners. We're up and rocking. So thanks for that question.
That was such a great intro. And I love the combination. You described yourself as a startup, but at the same time, you have this incredible legacy. And your dad, Bill Miller, one of the all-time great value investors, which we will get into later, is a 20% owner. And so you have this startup mentality. You're reviewing everything from your marketing to your incentive compensation for your employees. Yet at the same time, you have this deep-rooted experience and this value investing legacy. I also love, I think the third word out of your mouth was active. You're active investors, active managers. And before we move on, I just want to say, I love some of the stuff that y'all are doing. The transparency, you write little blurbs on your holdings, you're on Twitter, and the fact that you're a startup, but you already have 4 active strategies, I think speaks not only to your experience, but to your dedication. And I love everything y'all are doing, and I'm so excited for this conversation. So, what type of investor are you, and what types of businesses do you like to buy stock in?
I would say, I know the stock answer you expect, I'm a value investor, but in reality, we will buy anything that we think will appreciate at a faster rate than our cost of capital.
Mm-hmm.
I think a lot of investors become very dogmatic about process, and it ends up hurting them in the long run. So we're a generalist. It's really important. One of the things I've learned over the past decade that is not always obvious when you come out of school, having been taught value investing approaches and about the fungibility of dollars and how it ultimately ends up working over the long run, even though in the short run it may deviate from its intrinsic value. What you end up realizing the longer you're in the markets is there's a lot of people out there that don't invest that way at all. And in fact, they're just buying a stock because it went up for the past week.
Mm-hmm.
There's other people out there that are buying a stock because it has great quality metrics. And there's other people that are buying a stock because of some chart pattern. So the reality is there's a lot of different reasons that stocks go up. I mean, the reason is because there's more buyers and sellers, but there's a lot of perspective being employed when people take a look at the market and a stock, and you're probably buying from a guy who doesn't view it at all like you. And that may be why it never eventually gets to your target price. So it's really important, at least from my perspective, to understand that there's all different ways to make money in the market, and being dogmatic about process around value or definitions of value or all kinds of other things is not in your favor. It's not helping you solve a optimization problem, really. I always say more constraints, generally speaking, do not help you get to an optimum result in an optimization problem. So it's a good idea to look broadly at the world and employ a wide variety of lenses when you look at things. So we'll buy anything that we think will outperform our cost of capital, so long as it sort of fits within our mandate.
I love how simple the statement is so simple yet powerful. We'll buy anything that we think will outperform our cost of capital. I've almost never heard it put that way before, and I just think it's so powerful. And it speaks to your just really your mental flexibility. What is your portfolio management philosophy? How many stocks do you own? Typically, what is your average starter position size, average full position size? Do you hold cash, or are you typically fully invested?
Portfolio management philosophy is that most securities are fairly valued most of the time. And when you want to find something, in order to outperform the market, you have to look for things that are not a little bit mispriced, but things that are a lot mispriced. Because even if they're a little bit mispriced, just the overall level of randomness we just discussed may mean they never get to your target. So as a value investor, you want to look for things that have a big gap potential between price and intrinsic value, or a very long runway to go for a long time without having to sell. At the end of the day, in your last question, you asked about what kind of investor we are. And I mentioned all the variety of perspectives that are out there in the market.
Mm-hmm.
I realize that, there's a lot of other people doing this and coming at it from different perspectives. So as a value investor or as an investor in general, I want to maximize the probability that whatever we own is going to outperform. So I kind of think of myself as a little bit of a quantamental investor, actually, in that if you can quantify all of the factors that are likely to create a stock that's likely to go up over the long term and outperform your index, you want to have all of those things in your favor. So if you can find securities where all of the different lenses that are being employed on the market are in your favor, or all of those types of investors are likely to win and buy the security, you want to own that. So you want something that's deeply misvalued when you run a model on it. You want something that's going up. You want something that's not only going up and deeply mispriced, but where there's heavy alignment on your side from the management team, meaning they're making decisions on your behalf and they're making money as a shareholder, right? So you have alignment, you have value, you have momentum, and then not only do you want alignment with the people making the decisions, you want their capital allocation focus to match their strategy, right? So if they're saying their stock's undervalued, you want to see them buying the stock. You don't want to see them going out and doing M&A or doing other stuff. You want to see them doing exactly and you want everything to line up, right? So it's a question of alignment, not only in with the managers, but it's also with the factors that are likely to make the stock go up. And when you can find one of those situations where all of those things come together, that's when you want to bet heavily. And so we're looking for everyone's biggest constraint in their lives is time. So if you can find a way to spend the majority of your free time or your day doing this and just turning over rocks, and you can spend more time doing that with a better set of lenses than other people, you've got a pretty good shot at winning. At the end of the day, the question is the lenses and your ability to execute. That execution aspect is critical. And it's a question of focus and discipline and sitting down and employing the right lenses over and over consistently over long periods of time, and then making the right decisions based upon what those lenses and data are telling you.
Yeah. I mean, we're less than 15 minutes into this, and you've already mentioned alignment, I think 4 times, and it's so important. You mentioned that if the management team thinks the stock is undervalued, then they should be buying back stock. One of the things that's always fascinated me is, if someone is a value investor, and not speaking about you here, just in general, then supposedly they believe that every stock they own in their portfolio is undervalued. So it's almost like they should want every company in their portfolio to be buying back stock, because the stock would not be in their portfolio if they didn't think it was undervalued. So I like how you really just simplify everything. If management thinks it's undervalued, they should be buying back stock, not spending too much on M&A or something like that. So that was great. Thank you. Do you short or use options? Why or why not?
I do not short. I do not use options. The risk return skew is not great, right? When you short something, you can make 100%. You can, if you're wrong, it gets to be a bigger and bigger part of your portfolio, and it just gets to be a bigger problem. Whereas if you're long and you're wrong, it gets smaller. So just the overall makeup of shorting doesn't make sense to me. You're betting against someone. I mean, if you find a fraud, just stay away from it. You don't know if it's a fraud, but you never know, right? That's a low probability thing, someone to be committing fraud, but it happens. At the same time, betting on that is not a high probability thing from a base rates perspective. So I just tend to stay away from shorts for all the reasons listed. Options, different reasons, but so if our edge is supposedly understanding that things are going to be worth a lot more in the future than where people are pricing them today, I don't know necessarily when that gap will close, right? But when you buy an option, you're putting a constraint on your time, and you're also putting a constraint on the price at which you can make money. So I don't necessarily know the exact level. And when you combine those two constraints on sort of our edge set, it doesn't make any sense. In reality, options are a fee generation mechanism for banks. That's what they are. They could be a hedge. Hedging is a cost. We just don't do options for the expense and the constraints put around them relative to our edge. If I were like Ed Thorpe and had some quantitative way of understanding that they were systematically mispriced, yeah, we'd use options, but I don't.
Yeah, that makes sense. And like you said, you don't want anything that puts a time constraint on you. So I'm the same. No shorts, no options. How do you manage risk in the portfolio? And how do you think about risk management in general?
It's more of an art than a science. I think trying to put scientific specificities around it's a lot of false precision. It goes back sort of to what I said earlier, where if you can optimize your time and focus more of your time with better lenses on the problem, that process over long periods of time should ultimately play out. So what was the question again, John? I forgot where I was going with it.
No, just how you think about risk management in the portfolio.
Yeah. So, okay. So it's more of an art than a science for sure. Yeah. We try and every single position we buy, we think the risk is already mispriced. Mm-hmm. Now, from that perspective, you got to then understand that things are going to move in an uncorrelated fashion, and you try and construct a portfolio in such a way that those differing correlations are going to make it move, obviously, in a more diverse way than if you were all buying one thing. But there's different reference classes of risk, and having a variety of reference classes of risk is important. So, commodities versus, other things out there, which so it all depends on sort of what you're talking about from a risk perspective. I think people define it differently. I think a lot of the ways that people define risk is just outright wrong, and it fails to contextualize things. So when people look at everything with a endowment, mean variance portfolio optimization model, and I think one of the implicit assumptions of that model is that there's actually a draw against the portfolio every year, and not everyone contextualizes that, right? And so they just look at things because that's the way everyone else does it. And putting things into context is a really important differentiator, and I think our process as well.
That makes sense. So before we dive into your investment process, this shows a lot about process. I'd like to ask you a few questions about Bitcoin. So to begin with, what is Bitcoin? How do you define it? How do you see it?
I see Bitcoin as the world's fastest growing monetary technology. It's the first actual new monetary technology in eons. In that there's a variety of past ways people account for things, whether it's through scarce goods exchange, shells, or fiat-driven systems, which is what we all know today. Mm-hmm. Bitcoin represents the first time in history that a automated, distributed, transparent ledger system can account for the value, the transfer of value through space and time, without a third party processing that or blessing. And so that is a true technological breakthrough in human history. It changes not only that, but the other really interesting thing about Bitcoin, there's a lot of interesting things about Bitcoin, but the very nature of the energy intensivity of the creation of new units is just amazing, right? Because it links the siren call of the creation of new units, actual energy usage, as opposed to just waving a magic wand and saying something is so. Mm-hmm. So you get these really interesting feedback loops, these incentive loops that encourage increasing productivity over time and better behavior from people over time. The transparency thing is amazing. There's just so many incredible features of it. From a value investor's perspective, I know a lot of people out there might say, oh, it's not a stock, it's not a bond, this is silly, it's just based on others' beliefs. Yeah, it's just based on others' beliefs, but people are increasingly believing in for the past decade and a half because of the underlying technology's ability to scale and not change, right? And so it's this really unique thing that people are having a hard time contextualizing. But what I keep coming back to from a value investor's perspective is that at $1.5 trillion in market cap versus a fiat market approaching almost $2 quadrillion now, and up and up and up, $1.5 trillion is still too small for them. And so, we love it. It's my dad and I's, I think, biggest position by a long shot personally. And we'll probably continue to be that way. When we need liquidity or looking to buy something, we sell anything but our Bitcoin. And I think there's a lot of other people out there like that. And it's important to consider other people's perspectives when you think through markets. And when you look around your portfolio and you see, my Bitcoin's done better than everything else. Should I sell that if I need liquidity? Maybe I should sell something else. A lot of people are thinking along those lines, and that's why Bitcoin continues to go up. There's also this important investing principle, path dependency, in that, when a new technology emerges, there's a lot of competitors, obviously, to kind of a lot of times do what the new technology is trying to do, whether that's, in this case, other cryptocurrencies. But what you see in the past is that even though all these other competitors come out, eventually, a lot of times the first technology that was good enough ends up winning, even though it, wasn't necessarily the greatest standard, whether we're talking about a DVRAC keyboard or Beta versus VHS, right? There's this concept of path dependence, and Bitcoin is the winner. Okay, so it now has more processing power around it. You cannot possibly catch up to with these other cryptocurrencies, which creates far more security for Bitcoin than any other coin. And just the robustness of the underlying technology and network is just something we've never seen before. So we're massive bulls on it. We own it massively personally, and express that bet currently through MicroStrategy in our portfolios.
I mean, that was a powerful statement. When yourself or your dad need liquidity to buy something else, you'll sell anything but your Bitcoin. That's very, very powerful. And you touched on a lot. You touched on so much there. It's the first new technology, money technology in eons. It is much harder to create, if I understood you correctly, than just, waving a wand and printing money. It's just so energy intensive. Are you suggesting that creates almost like a governor on it? It forces productivity into the system because it is so energy intensive. Is that what you were suggesting there?
That's exactly right, and it's also it's a security thing too. So it does a lot of things.
Yeah. And then the thesis, I think you boiled down to there's a, what'd you say, 1.5 trillion market cap in Bitcoin versus a quadrillion for the fiat currency.
Global fiat capital.
Yeah. Wow. So there's a long runway there. You mentioned that you are invested in Bitcoin primarily through MicroStrategy. It trades on the NASDAQ under the ticker MSTR. Why do you believe MicroStrategy is the best way to invest in Bitcoin? What is your thesis in MicroStrategy?
Well, MicroStrategy is the largest corporate owner of Bitcoin. So if you believe that Bitcoin is likely to continue to gain share into the fiat capital accounting system, I think there's potentially enormous optionality tied to being the largest owner of that scarce asset. Whether it's starting a financial services company, that could be one thing. There's all kinds of different options, I think, longer term. But what's JP Morgan worth today? Billions of dollars, and $1 trillion. And what's the financial services arm of MicroStrategy worth today? Zero. So there's just optionality right out the wazoo. You also have margin collateral and accounts that you can't get necessarily as easily with holding the currency directly. And you also have an aligned actor. This is really important, running the firm, who can issue more equity if the firm trades at a big premium to its underlying holdings, and he could buy back shares if trades under them. Now, they haven't traded under their intrinsic value of the Bitcoin holdings plus the software business, I think, in a long time. So the premium now is large, right? And you're now looking at a time when there's a variety of ways to access Bitcoin through other wrappers, such as the ETFs recently approved in February. One of the most successful asset class launch in history, by the way, in an ETF, Bitcoin. Another important fact, and if you just look at what's happened, right, since Bitcoin was launched from this interesting little weird thing to now, you have literally the bond market seeing its value. When you see that, the best performing bonds in the past year are tied to Bitcoin, right? You got El Salvador, Argentina, Microstrategy. So, and there's more of this stuff coming. So, it's a really interesting time. I am incredibly fascinated by how few people are paying attention to the ecosystem, especially people that claim to be curious investor types, and they go, Bitcoin, I don't like Bitcoin, I never own Bitcoin. Okay, isn't the point of investing to make money? And so, okay, so why are you owning? Well, I don't know, it doesn't make sense. Well, I don't know, if I missed something that was as big as this is, at some point you go, okay, this keeps going, and it could, given the frameworks we've all talked about, like, you have to own some. Today, I saw a stat recently, 10.5 million wallets with over $1,000. Wow. That's all. 10.5 million with over $1,000, right? We talked about the overall addressable market for capital. This is still super early, in my opinion. And it's just something that enough people aren't focused on. And it's super interesting. The more Bitcoiners you actually talk to and engage with, too, you realize that they're actually a bunch of really interesting people who are very intellectually curious. And it's a cool group of people to hang out with. So I'll be at the conference this summer, the big one in Nashville. I talk about something there, but it should be a good time. Encourage you to check it out.
Nashville's a cool place to go for any reason, but it sounds like a great reason to go. So as the largest corporate holder of Bitcoin, are you suggesting MicroStrategy has an almost like arbitrage or leverage in the sense that when they are trading at a premium to their underlying holdings, they can issue that equity to buy more Bitcoin? Is there like almost like a leverage built into the model there almost?
They do have leverage, so that's a good point. They have debt, right?
Yeah. But almost like an arbitrage, almost.
Yeah, there's exactly. Yeah, I would think of it almost as a fiat conversion machine.
Okay.
Then, you can issue shares, get dollars, and you trade them for something that you're effectively buying something. It's growing at a much slower rate than what you're selling at, right? You're selling your currency in dollars, your shares in dollars, and you're using that to buy something that's being produced at a much lower rate. And it has a 15-year track record of doing pretty good stuff. So I think the market's obviously onto it. One way of looking at MicroStrategy today is maybe the equity market's discounting a run up in Bitcoin. Who knows? Mm-hmm. There's a lot of different ways to think about it and look at it. But to your point, if the stock value trades at a big premium to the underlying value of the Bitcoin holdings, plus the capitalized software business, plus the value of the optionality, which is hard to put a precise number on, mm-hmm. You want to sell shares and use that to buy Bitcoin, right? And then that's a very value accretive thing to do longer term.
Earlier in the show, you heard us talk about the investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing, options not suitable for all investors, and carry significant risk. Full disclosures in podcast description, U.S. members only. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the last 10 years? FinChat's got it. Like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. Want to see Home Depot's average ticket price or sales per square foot? FinChat's got you covered. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat and love it for the KPIs I can't easily find anywhere else, the awesome screener, and the quick and easy charting tool. To get 15% off any paid plan, go to finchat.io/JRO. That is finchat.io/JRO to get 15% off any paid plan today. The link will be in the show notes.
You mentioned these other wrappers for Bitcoin, such as the launch of these new ETFs. So what are your thoughts on investing in Bitcoin through these ETFs, such as the Fidelity Wise Bitcoin Fund or the Bitwise Bitcoin ETF?
If you want to own Bitcoin, I think the purest way to do it is to understand self-custody and actually do that. But you want to, at the end of the day, I think you want to own your own coins directly and have them in cold storage for a long-term investor. You know, if Bitcoin continues to catch on, there will be some ways that people will figure out to effectively recreate the problems of fiat-driven systems with, phantom accounting units and shadow leverage and all these other things. And you avoid that by holding the actual collateral directly and owning that information offline, right? So that is the best way to own Bitcoin, is to own it directly and cold storage it. The ETFs do that on your behalf, but longer term, you have potential counterparty risks there, whereas you don't have those counterparty risks if you have that Bitcoin and the keys in your possession.
That makes sense. And do you know what's going on with Grayscale Bitcoin Trust? Because it seems like it's maybe underperforming some of the others. I don't follow it that closely, but yeah. I
haven't followed it too closely since launch, even though I own a lot of it. What happened is I bought a bunch when it traded at 50% discount to NAV, and now with the launch of the ETFs, that's closed. The issue is now for me, there's big tax consequences tied to that situation.
Okay.
And so even though GBTC charges fees that are not, unfortunately, in line with the market, they know there's people like me out there that aren't going to sell when they do the math. So it's not a great situation. But at the end of the day, the fees here should all be really, really low for all of these things. Effectively zero if you self-custody. So,
yeah, that makes sense. Wow, thank you so much for educating me on that. So now I'd like to dive deep into your process at Miller Value with the next several questions. So to begin with, you mentioned you're sort of in the startup phase, but how many people are on the investing team? You did mention that you're a smaller team, so you're all generalists. So is it how many people are on the team, I guess, is my first question.
3 full-time investors, all very experienced, and then my dad. So account for him however you please. And then we have 3 full-time ops team members, and then 2 partial team members. I effectively count them as like half-time because they work for a variety of, we're not the only client.
How many stocks do you think an analyst should be able to cover well?
Cover well. Gosh, it depends on how you define cover
and
what the expectations are.
Yeah.
I
mean, 20. You think they could handle 20?
Well, let's think about it like this. Like when I look at our portfolio of 20, like as PM and being effectively taking on full responsibility for all of our names, 20 is a lot.
Yeah.
20 to 30, that's a lot of names. So
it is.
And you have to know them well. So it's probably right around there, like in my opinion. And it depends on how you view them and what is your epistemological threshold for what you're doing. And so it's really context and process dependent. One of my favorite sayings is the IP has to match the investment process or the portfolio construction process. So, for me to think that I'm going to generate alpha on the 7th page of spreadsheet, it's not happening. Like, that might happen at Fidelity because the analyst is real deep into the industry and they know that something's happening with, some margin over time. I don't know. Who knows? But that's not where we source our edge. It's in the whole systematically putting new lenses onto the market, running it from screens from new perspectives, constantly, I spend most of my time at the top of the funnel, turning over stones, right? And then, okay, once you hit that epistemological threshold for something, it's okay, where does this belong from a risk perspective in the portfolio relative to kind of my assessment of the risk return skew, right? And so for us, that's, 20-ish names, 30 names, probably not too many more than that. It might be a little different for our income product just because some of those are bonds, and some of those are overlapping positions. So we might own the equity and the debt. But yeah, it's hard to do more than 30 names really well, I think.
Oh, I definitely agree with that. And I appreciate you saying that you spend most of your time turning over rocks, the fill or kill process. Quickly or fairly quickly, I assume, going through ideas to determine whether you want to then dive deeper or move on.
Exactly.
Yeah. So how many new ideas do you need a year? Or how many new ideas do you expect a good analyst to provide you in a year if you have 25, 30 holdings in your fund or in your strategy?
I'm not sure I'd say I expect something
Okay.
from our analysts. I expect it from me. So I expect from me, I'd say 2 good ideas a month, and that's turning over rocks all day, every day. And so, maybe 2 things, and they ultimately may or may not make it into the portfolio depending on risk considerations or other things. But yeah, 2 a month is that's good. I mean, 2 a month is good, but if you find one real good one a month, you want to bet heavily on it and then move on to the next thing.
Yeah. I love how you describe your day to day. It's not, the 12th tab on the 7th page of an Excel spreadsheet. It's turning over rocks all day, every day.
Yeah,
Looking
it's
for
comparing,
yeah.
it's running screens from new lenses, it's running the right lenses. It's also turning the lenses from new perspectives based on what's going on in the market, and then sifting through what sorts of ideas those things kick off. And then they kind of need to eventually hit our checklist on all that alignment stuff. And well, yeah, they need to hit on the alignment stuff. So it's just turning over stones and comparing. As a generalist, one of the other mental toolkits I use is there anything like this but better? So okay,
Ooh,
you
I
find
like that.
something that's really good, and you go, is there anything kind of at this valuation but better, growing faster,
Mm-hmm.
better alignment, better this, better that? And so you're just looking to get all of those things lined up as maximum as possible.
Wow. I'm stealing that for sure. Yeah. So go into a little more depth into your step-by-step process of what has to happen for a new name to get into the portfolio. So, from the first day you turn over that rock to the time you decide to put it into the portfolio, what does your research or due diligence process look like? What are you reading? Who are you talking to, et cetera?
I'm going through the quantitative metrics, balance sheet, free cash flow yield, capital allocation plans, 5-year strategy, how much cash is going to kick off in 5 years, where's it likely to trade today versus in 5 years. I'm looking at it depends on the situation. My dad always used to investing as a game of epistemological thresholds. Like, how much do I have to know for this to actually fit into the portfolio and make the cut?
And I assume it can be a different amount for different names. That threshold
Exactly.
is different. It's case dependent, right? Yeah.
Yeah. In some cases, he would just say, okay, this is like one of the great, insider purchasers of all time, one of the great capital allocators, making a massive personal bet. I could just buy on that alone. He would do stuff, so we don't necessarily need to be reviewing extensive models or things like that, as long as certain things. But it's really context dependent. So like yesterday, I was looking at a small cap name that was up big in a weak small cap tape on an insider buy. And so then when I went through the situation, It's actually interesting, right? Because this is people say, oh, you use AI, you can use AI to program active manager stuff. No, because I think the context varies. The context is almost has an almost infinite potential to vary, and that context is always what matters. And it's very hard to evaluate new contexts and the combinations around them. So this company that I was looking at, which had this big insider buy, 6-figure insider buy, I go look at it, I pull it up. Turns out that the insider that bought, a couple $100,000 or whatever of the stock, I think he owned like 80% of the company. Okay, he just paid out half of the hundreds of millions of dollars of the cash pile in a special dividend to the shareholders. So not only that, there was then some C-level turnover. I think it was a CFO leaving, or then a change of an auditor. You go, okay, what explains this insider buy? Well, what explains this insider buy is optics signaling, right? Because this guy's not making a meaningful bet at all. But someone's buying it on that. Is that a computer? I don't know. It's probably not a good bet when you put it into context, though. So everything needs to be contextualized, and that is ultimately your job as a portfolio manager, are those epistemological thresholds and sets of context that get you to pull the trigger.
Yeah. I think in investing, some investors tend to oversimplify things. And so, there's this adage out there that insiders will sell for any number of reasons, but they will only buy for one reason, and that's if they think the stock's undervalued and it's a good buy. But that's just not true. Sometimes they will try to send a signal to the market, as you just explained. And David Einhorn talks about that in his great book. It's more complicated than just a simple adage. All insider buying is always bullish all the time.
Well, so the saying that the one I've heard before is, there's a lot of reasons people sell, but there's very few reasons people buy.
Right.
So yeah, we don't spend a ton of time looking through insider sells. If somebody changes price triggers around a 10b5-1 or something, it's interesting, but
totally. Yes.
But
the buy, sometimes you have to, look into it. Maybe there is some optics, some signaling to the market.
Yeah, all insider buys and all alignment is not created equal.
Not all created equal. Exactly right. Yeah, exactly right. So, let's say you start scaling the firm, which I 100% expect will happen. You start hiring some more analysts. If they pitch a stock idea to you, an analyst, what would you want to see from them in terms of a deliverable? Would you just want a verbal pitch? Would you want a write-up? Would you want a PowerPoint model attached to that? What would you expect them to deliver to you?
Just the content that meets those epistemological thresholds. And it varies. So they put together a half page or 1 pager on something, and you go, okay, this is interesting, but it's not worth a 5% position. This is a 1% starter, or maybe we get to 3 over time just because of the potential upside, or whatever the reason is. But for me, the deliverable is something that makes me pull the trigger. Like, I don't want a note that's not going to make me do anything, right?
Yep.
There has to be an action item associated with it, because I'm sitting there watching the same names, and I shouldn't say I'm watching the same stuff he is, but I'm obviously keeping a very close eye on everything going on with all of our names as well.
Yeah. So talk to us about the idea generation process. How do you source new ideas? I think you just mentioned one of the things you do is look for insider buying and try to understand what's behind that. But are you running screens? Are you getting ideas from a network of other investors that you are connected to? Are you attending conferences? What are the main ways that you find new ideas?
The best ways I find new ideas are what other smart people are doing. And that is easily the highest signal value source of ideas for me, is looking through other investors' portfolios whose processes I respect, and then seeing what large moves they're making, and then figuring out if those large moves somehow align with our process, and we can reverse engineer as to why it's important. A lot of times I'll look through other times I'll look through really good investors whose process I respect, and I'll look at the name and I have no idea like what this guy's doing or why he likes this. But But when it all lines up, you go, oh yeah, that's a good one, right? So that's a really high signal value. We're always trying to filter noise and look for signal value. So that's a super high one. Another one's insider activity, contextualizing all that properly. And then the other one, which is really important, is I run systematic screens on the whole Russell 3000 probably once a quarter. And I pull in enough data from Bloomberg that they have made me sign legal documents saying that I'm not a quant firm for as much as we're pulling in. But we pull in a ton of data. We rank all of these various things. We sort it and see what shakes out. And then we put it through our qualitative checklists around alignment if we can get a lot of the data lining up from a screen perspective. So it's those three things I'd say are our primary sources of new rocks.
I love that. What do you look for in a stock pitch? What do you want someone to communicate to you in a good short elevator pitch on a stock? Is it that he or she thinks the stock is undervalued and why and by how much, or is there more to it for you?
It's just how much it's worth, where it's trading today, why it's trading there, where it could go in 3 to 5 years, why it could go there, and then what are the challenges and probabilities that it eventually gets there. Those are the main things. And then, again, it's got to also fit the alignment check marks, capital allocation check marks. I also, one of the things I've done and found valuable, which most value investors would go, but I did the CMT program. I did the CFA program, but then, 8 years ago, I also did the CMT program just because there's enormous power in terms of like listening to the market and understanding what technicals are telling you in the relative moves. And you can infer a lot about what other investor psychologies or what other investors are thinking about just by looking at relative moves and all kinds of other things. And you learn that through the CMT that CFA necessarily doesn't review. And there's a huge swath of the market that focuses on momentum, and it's actually proven excess return factor. And so it pays to study that too. So that's something I like to see when we look at a position, actually from a checklist perspective. I like to see a technical reason. Like if you think something's undervalued and it's going to go up a lot in 5 years, you don't want to see a chart where it just goes like this. It's at a new low, right? You want to actually see evidence that others might agree that in 5 years, something could be happening, because you got to understand there's other people out there and their opinions ultimately influence your results. So that's important.
Yeah, I haven't gone through the CMT program, but just personally, I'll almost never say never, but almost never invest in a stock that has just gone down year after year after year after year. But what I like to see is a stock that has a long history of going up, but for some reason has gotten knocked down recently. And then I do with the research, and I believe that it was a temporary thing and that I can recover to a new high. But I do like to see a long-term track record of value creation.
Yeah, I love that too. And that also in that chart that you're talking about, John, the other thing I like to see on top of all that is I love to see that pattern combined with an all-time low on a cash flow valuation metric.
Oh, now you're talking my love language. Yeah, like seriously, for sure. Yeah, so really, really high free cash flow yields. Yeah, we're gonna get to valuation in 1 second. How much time do you spend thinking about the macro backdrop? And do you have a current macro or market outlook that you hold with high conviction?
I probably spend a lot more time thinking about it than I do actually managing to it. We don't change our portfolios drastically relative to macro outlooks. Unless there's a strong valuation component to it. So, one thesis one might have right now is if you just look at the utilities space, this is a bit of a macro / valuation call. The utility space trades at a really big discount to its history relative to the S&P 500 at a time when realized volatility super low. Expected volatility, as evidenced by the VIX, super low. So one might call that complacency. I don't like that term for a variety of reasons we won't get into now, but it feels like people are all very comfortable. Summertime, vol's low. Utes are really inexpensive. So that might be a nice place to park a little cash or be overweight right now. But that's sort of a macro thinking perspective vis-a-vis valuation we might incorporate. I spend a lot of time looking at macro factors like, thinking through what might explain this from a macro perspective. So think about like the 2 to 10 year inversion, right, on the yield curve. Everyone's wringing their hands when that happened. Oh my God, we're into recession. Still haven't hit a recession. Well, if you think about it, like we fast forward a few years and we look back at this, what might explain that? Well, COVID might explain that, and kind of the unique manipulation of the dollar, the total outstanding fiat stack to offset all kinds of demand shocks and other things. So maybe that would be a good reason that something without a strong statistically strong track record, why that didn't work out. Okay, well, that's a one explanatory factor that may be the case. Even though macro historically it says something bad's going to happen, but nothing bad's happening right now. Things are pretty good. So I think about it a lot, and I think about it vis-a-vis valuations, but I don't adjust portfolios to that.
Super interesting. So you think that, so I actually did see today that the 10-year 3-month it's been inverted for, I don't know if it's the longest ever or the longest going back 3 or 4 decades, but it's up there with it's the longest inversion on record. And so you think maybe it is sending the wrong signal because COVID was such this abnormal event.
Yeah, I mean, if you think about where we are and sort of just at a high level, you have inflation that has proven stickier and stronger than anticipated when you got a rate at well above what I think most people anticipate neutral is, right? Five and change here for a while, and things are still going strong. Pricing pressures are still strong. Marginally, though, the marginal evidence shows things are coming down from a pricing pressure perspective, and that the policies are indeed working. It takes time.
So just back to valuation really quickly. How do you think about valuation? What valuation methods are you using? What valuation multiples are you typically comfortable paying?
It all depends on the business, the addressable market, how big it could be in 3 to 5 years, what people are likely to pay for it then. Like we own Stellantis at 2 times EBIT.
Yeah, it's a beautiful thing. It really is.
It's a beautiful chart. It's well run. That's a great one, right? And would it be too expensive at 3 times EBIT? Or not?
Right.
Times EBIT, probably not. Like, I don't know. Is it going to get there? Hopefully, there are buyback stock. Again, there's a lot of randomness. The valuation multiples, it all depends. So, like, we own in the appreciation, strategy. Coupon is a major holding right now. It's our largest holding, and that's a 5 and change free cash flow yield. But you look at how fast that's growing, how much cash that thing could kick off in a few years. You look at where Amazon's bottomed historically on a valuation basis, it's there. So I think that, no debt, net cash, I should say net cash positive. Yeah. That's the kind of thing like, okay, that's trading at the free cash flow to EV yield on coupon is now the same as it is, higher than it is on bonds. And this thing's going to grow and be dominant, probably more dominant than government in 10 to 20 years for, depending on what your perspectives on things are. But that's a pretty compelling long-term holding from our perspective at this point.
I mean, that all makes perfect sense. Full disclosure, I own both Stellantis and Coupon. Talk to us about selling. Under what circumstances do you trim, and under what circumstances do you sell out completely?
That's a great question. And my thoughts on this evolve too, and continue to evolve every day. With kind of the portfolio we're putting together in the appreciation strategy, with everyone having alignment, just dominant companies, we're more likely to just cut heavily and leave it in the portfolio at a really low weight and watch it and see if it doesn't come back at some point. Just than we are to completely eliminate some of these things now. Builders First Source being an example, we cut that back pretty heavily. a couple weeks ago. But that used to be a major position. So where the weights, everything comes down to the weights. So I used to play a ton of poker, no limit hold'em. That is probably the best training for what I do every single day now, because you are allocating capital to a variety of different bets. You're managing a stack of money and you have to control the risk of it. It's all about risk return skew, probabilities, gain loss. So that's what everything comes down to, is the position size, how much weight from a no limit perspective you put on any given stock. And that's where all the torque is. So the things where I think have the best right tail to long tail ratio, those are the things that they're going to get the higher weights.
A lot of really good investors play cards, whether it's poker like you, David Einhorn, Warren Buffett plays bridge. I'm just curious, was your dad a card player? Or is he a card player?
He's a competitor.
Yeah.
So he liked to compete at whatever he did. I think that would be definitely the common thread. And competed just ambiguous stuff, just stuff, whatever, just random things you wouldn't even necessarily think of. But he just could always good at competing and found a way to compete. And that's what it comes down to. It's enjoying playing the game and looking for edge and ways to compete against a really challenging opponent set in the market. That's what's so fun about what we do every day.
Yeah. Why did you trim back Builder's First Source? Was it the disappointing earnings a few weeks ago?
No, it was a valuation thing. So I think when we bought Builders, it was a much higher free cash flow yield. And now what you've seen is the stock run way up to a value that actually makes sense. You see them cut back on their buyback plan, which I think is telling. You've seen them, and if you just look at the valuation relative to other stuff out there, it's high single digit free cash flow yield, I think, here. Which is good, but rates are rolling over. Their results near term are pulling in from a cash flow perspective. So now you got a high single digit free cash flow yield. The market likes to capitalize the most recent trajectory change. So now it's going down, right? So it's probably a decently, I don't want to say it's fairly priced, but it's run up a lot. So it's no longer represents kind of the bargain it did at a much higher free cash flow yield when rates were low and everyone was buying houses out the wazoo. So
yeah, that's fair.
The risk reward skews shifted.
How do you spend the time in your office? I mean, I think you said you're just turning over rocks all day, every day. But what are you reading specifically? Is it newspapers? Is it, industry journals? Is it sell side research? Is it, different blogs and stuff online? How do you spend the time in your office and what are you reading?
I try and get access to as wide a variety of things as possible. So I try and look at everything. We get all kinds of sell side research. We get, Bloomberg's on my screen all day, every day. I'm looking at relative movements, trying to explain causationally why things are doing what they're doing. And then, one of my favorite sources of ideas is looking for weird market movements that conflict with each other and then figuring out which one's likely to be right, just because the markets has such powerful wisdom in it. When you find things that don't make sense or juxtaposed, you want to dig into that and figure out which one might be wrong and if there's any potential there or if you have any edge to bet on it. So it's looking at market movements. It's looking at sell side research. It's looking at social media. Social media. I don't read newspapers.
You can get it on social. Yeah,
you just get it on social, and you get it. We get Bloomberg news. You get all the news on Bloomberg. And the real news to me, like newspapers are stories. They're increasingly tabloids, paid content, right? The numbers moving on Bloomberg are not paid content. That's reality. So that's where I'd spend most of my time focusing.
So where do you see Miller Value Partners going in the next 5 years?
Plan is to just execute on our strategies right now. We have, 4 really compelling strategies with unique IP, I think, and all have, I think, really bright prospects relative to their benchmarks. And the idea is just now to execute on it. So we're not actively looking at new products or asset gathering or anything like that. My day to day is more just sitting at my computer turning over rocks. That's what we want to do, because we are the largest clients, so we're doing this for ourselves as well. And we appreciate and love all of our clients that will come along for the ride.
Yeah, all largest client across all 4 strategies, I think you said.
Yeah.
So I interviewed your dad back in August of 2016. He beat the S&P 500 for 15 consecutive years from 1991 through 2005. He was recognized as the fund manager of the decade by Morningstar in 1999 and the greatest money manager of the 1990s by Money Magazine. He was named to Barron's All-Century Investment Team in 1999. He is, in my opinion, on the Mount Rushmore of value investors. So what did you learn from him about being an investor?
I think it comes down to just the dedication and the focus. I mean, watching him day in and day out, every single day, he was at his computer, or not, he was in his office, but he was grinding. Like, he was zoned in, he was engaged, right? It's all about focus, consistent focus and grind. And that's ultimately an edge. And so he's obviously incredibly smart as well, but that's not enough in the market. Everyone in the market's incredibly smart, but he put in the time, he did it. So that's what it's about.
I'm curious because, a couple of years ago, Barron's magazine, which I read, did say that your dad, at the time at least, had become a billionaire, which is just awesome. And so he doesn't need to be doing this anymore. So my question is he still doing it? Like, is he still grinding? Is he still, thinking about markets every day and picking stocks, or is he more in retirement mode now?
He's online most of the days, at least for a couple hours a day. He's on Bloomberg looking at stuff. So I can see
every day. I love that. Every day, still doing it.
I don't know. It's most days, so he's punching in, and just poking around, seeing what's up. He's probably going through the insider buy list every week. He loves the game, right? It's a game. It's fun. He's obviously doesn't now. The nice thing for him, I think, when he says he doesn't have clients, he doesn't now feel like he has to do something for someone else, right? Like,
sure.
When you have clients, if you don't feel a sense of obligation to get up and start turning over rocks immediately, you probably have deeper issues. So he doesn't have that anymore. So that's kind of what that's the differentiating factor now, is he can go focus on his Hopkins board meeting without thinking, oh my God, like, this stock's moving, I should be looking at selling this. He doesn't have to think about that anymore. But it's just a focus thing.
So you just mentioned he sits on the board of Hopkins. He also served as chairman of the Santa Fe Institute from 2005 to 2009. So my question is, do you share his interest in complex adaptive systems and how that relates to markets and economies and investing? And if so, how do you incorporate complexity theory into your portfolio management?
Yeah, I think it just goes back to understanding. It goes back to my comments earlier on the nature of all kinds of perspectives being incorporated into the market.
Yeah.
And the broader your set of perspectives, the more likely it is that you can identify opportunities from others' perspectives too. I'm not necessarily as big into the complex adaptive systems and science angle of his views, I would say. I'm more of a literal person, so I don't think you would hear him describing. I don't know if you would hear him describing turning his days, maximizing his time turning over rocks. Although that is something I learned from him, is that he had set up his entire day so that he did not have to do one thing except literally look at stocks. So I mean,
Wow.
he had somebody to do every single aspect, I'm gonna say, of his life. But I think that's what allowed him to be so good, right? Is that actual focus on the craft.
I don't think, and you've hit on it a couple of times today, Bill, but I don't think enough investors appreciate the grind that it takes, the work day in and day out, the hours every single day, day in and day out, that it takes to be great at this game. And I know, like I said, I interviewed your dad and I followed his career, and I read William Green's great book, and I know how just committed and dedicated you both are to the grind and to winning ultimately. So we dove very deep into Miller Value Partners today. Is there anything we missed or anything else you'd like us to know about your firm?
No, we're here for the long haul and fired up to help our clients generate excess returns. That's about it.
Bill, this was incredible. I had so much fun. Thank you so much for coming on the show.
Thanks so much for having me. It was a lot of fun to be here.
Yeah, it really was. I hope we can stay in touch.
Thanks, John. I appreciate all your time and help.
Great. Before we sign off, I'd like to provide a quick reminder. Anything discussed on the J-Row Show by myself or my guests is solely our own opinions and does not constitute formal advice or a recommendation. The J-Row Show is for entertainment purposes only, so please do your own research on any securities discussed in this podcast. Thanks for tuning in, and we will see you next time.